Well, welcome everyone to Impact Dashboard Live. Today we're going to take a look at our online economic development impact model. But to get our bearings, first I want to start by taking a look at what we're trying to do and kind of where we're heading with this model. We're going to take a look at the online model and see how to produce these reports, but let's first take a look and see an example of a report that we can produce with Impact Dashboard. So here we're looking at a pretty much overall summary of the impact of a new economic development project. On the left-hand side here, as I'll zoom in, we have some details about economic impact. So we're showing how many jobs are being created through direct as well as the spin-off or indirect and induced activities. We're looking at the salaries that are being supported. We're summarizing the capital investment that's associated with this project and even some things about residential development. On the right-hand side, or kind of the main section of the report, this one-page summary report, we're giving an overview of the tax benefit for one of the tax entities. In this case, it's the city. We can look at this from any perspective we'd like. So whether it's the city or the county or the school district or any of the other entities, we can zoom in and see what are the net benefits to be received over a period of time, what are the sources of those revenues, and how do they compare to the costs that might be associated with it. We'll take a look at this in a little bit more detail, but we can see there's a graph of what this looks like over the first 10 years of the project, showing the benefits in the dark blue, the costs here to the bottom on the little bit lighter blue, and then a net benefit line in that orange that we see. And then at the bottom of the page, we're giving a summary, in this case, of a property tax analysis. So there's a property tax abatement being considered from the city, and we want to see how does that affect the overall property taxes that are going to be generated from this project. And so on just this one page, we can get a really good overview of exactly what is going on with this project, Project Hello. And so that's a little bit about where we're heading with all of this, with what our reports are going to do or be able to produce for us. There's actually a more detailed report that provides a little bit more of a narrative. As we get into it, I'll show you what that looks like. But now I want to just give you a little bit of information about Impact Data Source and my company. So Impact Data Source is a economic consulting company that was created in 1993 by my partner Jerry Walker. My name is Paul Shurin. I'm an economist and partner with Impact Data Source. What we're looking at here is a map of all of our model clients across the country. We have model clients, probably about 80 or a little bit over 80 model clients or clients that are using our model across the country. This is a list specifically of those using our model. We also do individual reports. So for clients that don't necessarily want to do the reports themselves with a tool that they're using in-house, but they might just want, our company to do kind of a one-off report for them. And we have many more of those types of clients. As you can see, we kind of work across the country in many different states. And as I mentioned, our services are kind of available as software or straight up consulting services. What I want to do is kind of show you how you get into Impact Dashboard. So I'm going to log in. So right now we're on the login screen for Impact Dashboard. I'm going to log in with my account for kind of demoing and testing things. So here's my special account, and we're going to log in. And this is actually set up to be a Texas based client. So a lot of what we look at in our model is kind of a reflection of local tax structure. And so depending on the particular state we're in, you'll see different sources of revenues or things. And in Texas, some of the big ones are local sales tax and property tax. It's pretty common across a lot of other states too. But to the extent that you might have local income tax, or maybe you don't have local sales tax quite the way Texas does, your model would be customized and put together so that you only see the sorts of revenues and impacts that are relevant to your community. So here I'm logged in as my client here, as it would be for anyone logging into the app, and we're facing a list of all of our projects. So this is a list of our active projects here. As I scroll down, I can see all of those here. If I click on one of these, like we're going to look at Project Hello today, we can see I've got a number of different scenarios, and I might be able to kind of copy that scenario and create another iteration off of that, or even delete some of these. But you can see I have a number of different projects here, and I can click on any one of those and see different number of scenarios. This is on my active projects list. I also have an archived projects list where I can look at maybe some projects that aren't in the running anymore. So in order to keep things clean, we can kind of have these two different pages to keep active projects separate from archived projects. Now, if I wanted to create a brand new project, I could just click New Project here and give it a title, and I would just add another row to this list of projects that we see. Now, what else I can do here is to be able to move this project. If I wanted to take an active project, put it in the archive list, if I wanted to rename it, or even if I wanted to delete the project, I can handle all of that here. I'll come back and talk a little bit more about the features or some of the options you have here on this screen in just a moment. But here with Project Hello, I'm going to jump into this 30 jobs option, and actually this is the version of the report that we were just looking at in that PDF example. But now we're in the actual app, and we can see how that report came together. So if you remember, I'll pull up the PDF real quick. So this is what the PDF report looked like that we started from. This is kind of where we're heading. And that's actually available here on this report tab. So if I click on the report tab, I can see our summary report. This is that one-page summary, and I just printed it out of this model. Now, how did we get here? We can go back to our scenario info, and this is where we've entered in all of the project-specific information to kind of derive these results. And so the first section here, which we can click on here for general info, we can see this is where we can give a name to that scenario. We could even type in a description. I haven't typed in a description, but you could type in a description here that would flow through to the reports. It could give a little bit more of a context to the narrative as you're reading through the report or as others are reading through the report. And then you specify where the project is located. And so most often we're setting the model up for maybe a specific city or maybe a county-wide organization or maybe just a region. And so you'll want to have the ability to specify what city the project is located in, what county the project is located in, and which school district might apply. Now in this case, we've got some extra taxing districts like road district and water district, and those are just kind of examples of the other entities that very often come up as you're looking at the detailed property tax bill. So other examples there might be like if there's a college district or a hospital district and things like that. So this is again just a representation of kind of an example. Now the other kind of major input that we have on this first screen is the industry. And so this is where I've selected chemical manufacturing, inorganic chemical manufacturing. But this is where you could start typing and really select nearly any type of industry. So if I just start typing general warehousing, which is one of my go-tos for selecting a different one, we can see that I'll pull in multipliers for that particular industry. So we're selecting the industry, which is going to drive our multipliers. We're building in most cases, our RIMS2 multipliers. Those are from the Bureau of Economic Analysis. We're going to get them for your specific area. So not only are they going to be region specific for these multipliers, but when you are working on a specific project, you're going to tell us what industry that is, and we'll make and that selection will make it industry specific. So let me go back to my original multipliers, which were chemical manufacturing. We can start typing that, and we can see that we start getting a couple different options based on what we've written there. And I believe it was our other basic inorganic chemical manufacturing. And so that is going to give us multipliers here, in this case for the employment multiplier of 1.38. What that means is that for every direct job that's created in the community, there's going to be 1.38 total jobs. So that includes the one direct job as well as the 0.38 spin-off jobs that are created in the area as well. If you need to, our model's flexible. You can type in, you can enter custom multipliers and just overwrite our numbers if you'd like to. Now on this scenario info screen, as we get out of that general info modal, we drop back in and we can see all of these inputs that we have, options to enter information. So here's our jobs. We're asking for the number of jobs being created each year. So over the 10-year period, is there a phase in for those jobs? And so again, we can see we've entered 10 in year 1, another 10 being added in year 2, and then another 10 added in year 3. So for a total of 30 jobs. So on the right-hand side, we're starting to see some of the results. And actually, since we've entered a lot of information already, we can see the results have already calculated out here. Related to jobs, we can see we've got 30 direct jobs. And using our multipliers that we just talked about, we've got about 11.5 spin-off jobs, and that results in a total of 41.5 jobs across all of the activity here. Now, if I click continue here, we'll go through some of the other inputs that are being used in this. So as we think about those 30 jobs, who will be filling or how will we fill those jobs? So 30 new jobs in the community. Some of those workers might already live in the community and they'll say, hey, great, I got this opportunity to work here. And so that would be a case of, a local person filling that job. In some cases, you're going to have people commuting in, and so they live nearby. They don't necessarily live in the particular city, but they're going to commute in. So that's another source of employees to fill those jobs. But then we have this third category, which we really want to dig into, and that's where workers might relocate to the area to take some of those jobs. So this question is asking us what percentage of the new direct workers out of that 30 workers will be moving to the city. And so here we've got a default of 7.5%. We can override that default if we have more information. For example, that these 30 jobs are going to be very easily filled by people that you have right there in the local workforce. So we could zero that out, put it down to 0. Or you might be looking at a different scenario where maybe the business tells you they're going to be relocating a bunch of workers and maybe 80% of the workers are going to be relocated. And so that might look a little different as well. So I'm going to reset this to the default. The default is something we come up with in looking at the specific community and some commuting patterns and so forth. But really, this is something that our clients will need to address on each individual project, just thinking about the specific jobs being created and the local workforce. Now, the next input asks about average salaries. And I'm showing just 5 years here to start, but we can see if we stretch that out. We're showing all 10 years. I've typed in this number. I've got $38,000 as my year 1 salaries, and then I have a percentage increase of 2%. Now, if I wanted to change that percentage increase, I could say, well, no, actually, they're going to start at $38,480, but then they're going to increase by 5% per year, and I could have that increase all the way down. Now, let's say that, for example, it didn't actually increase by a percentage increase every year, and this year, in the second year, let's say it was $40,000 in year 2, and then in year 3, maybe it jumped up to $45,000, and so you can modify this so that it's not always going straight by the average annual percent, but it is a handy piece if you don't have all of the information, and collecting 10 years worth of salary data can be a little difficult. Now, the next input, we're asking for capital investment. I'll stretch this out to show all 10 years again. We're asking for the amount of investments each year. So we're going to make a bunch of assumptions in the back of the model, which you have control over to kind of modify how this property, these investments, translate into taxable property. But essentially, we're saying that if you're going to spend $2 million for a building, we're going to assume that there's going to be some real property coming on the tax rolls in that amount of maybe $2 million. Now, over time, that taxable value might increase due to real property appreciation. These are all assumptions that you can modify in our model. Then the furniture, fixtures, and equipment. If you're spending $6 million to furnish out this new building, the FF&E there in that case might be subject to some depreciation over time. And so again, we have a depreciation schedule built into the model that you have the ability to control for a specific analysis and really zero in on the taxable values. The last few inputs that we have here, as we continue to kind of go down through, you can put in building permits and fees if that's going to be a source of revenue for the city or for the county, for example. In our model here in Texas, we've got taxable inventories as an input. This is something that may not apply in some other states, which is pretty common. And so if in your particular state, let's say that you don't have taxable inventories or inventories are not taxed, essentially, you wouldn't see an input for this. This is, again, a Texas model, Texas taxes inventory, so you're seeing an input. Now, the next inputs are related to taxable purchases or taxable sales, and these are important in Texas because a lot of communities and cities and so forth have a local sales tax or receive a portion of the sales tax rate. In some states, really, they don't have any local share of that sales tax, maybe other than what might come from the state revenue sharing. And so for states that might not have local sales taxes, you wouldn't see these inputs. Now, local taxable purchases and taxable sales, we're thinking about from the firm's perspective. So in the case, if the firm is making taxable purchases throughout the year, that might be some amount here, usually not very large. And then taxable sales, this one, in the case of a manufacturer, most likely would be zero unless they're selling some actually locally there. But taxable sales would be important for other types of businesses, maybe not in the case of a manufacturer, but in the case of like a retailer or a restaurant, you would have taxable sales, and that could be a pretty significant portion. As we look here on the right side at the dashboard results that we've got calculated already, we've talked about some of these economic impacts already. But now we're seeing our net benefits for the city of $400,000. And so this shows us that there's benefits of about $520,000. We've got costs of about $100,000, and so our net benefits of about $420,000 over the 10-year period. We see what that looks like graphically over time. We can hover over these and see what these amounts are. Now we can even take a snapshot and get a sneak peek at what happens for the county. In the case of the county, there's net benefits of about $330,000. For the school district, we've got net benefits of about $200,000. So with just entering all that information about the economic development project, we're calculating these results for each one of those entities. Now we go to the reports again. We can see our summary report is showing us just what we saw before. And this, if we noticed, we had a property tax abatement. We're going to talk about how to implement that tax abatement in the model. So on this public support tab, we have the ability to specify for any one of the tax entities, whether it's the city, the county, the school district, or these others, we can specify a property tax abatement or a property tax exemption. In the case of this example that we have, I've got I'm modeling a 100% building tax property tax abatement. So if we look on the right-hand side, we can see that we've got some numbers here helping us understand how all of this comes together. This graph is showing us the liability in dark blue, and so the annual liability is shown here, but across all 10 years, that sums up to be about $530,000 in property taxes that the company would have to pay to the city. So again, this is the firm's property based on the city's portion of the property tax rate. It's going to be about $500,000 over 10 years. Now, if the city were to consider this incentive, this property tax abatement of 100% of the building taxes over 10 years, we can see what that value is each year as we've deducted it off of this in this graph. We can see that if we add up all of those 10 years of abatements, that value is about $144,000. So now our net collected, as if we're the city now, our net collected from property taxes specifically is about $386,000. So now if we go back just to try to see how all this comes together in the report, the one-page summary is showing us these net benefits after taking into account the value of this property tax abatement. So you can see our real property taxes are zero, and that's because we've basically abated or exempted all of the building taxes. We hadn't put any value of land in there, just thinking about the net increase in things here. And so the real property taxes are zero. We're indicating that the value of that property tax abatement is $140,000. And so our net benefits are $424,000. Now, if we were considering, or we were kind of on the fence trying to look at this both with and without the incentive, we could uncheck this box here, which would remove the tax abatement. And so there would be zero abated. And now, if we go back to that one-page report, we can see now we actually are receiving those real property taxes of $144,000, and our net benefits overall have gone up by that amount of $144,000. So that's how we're working through this analysis to try to have the net benefits reflect truly the net benefits after accounting for those incentives. So let's go ahead and put that back on. Let's implement that in tax abatement again. But also, let's think about if we're going to offer another type of incentive. And so, for example, let's say that the city was thinking about paying for some infrastructure, and it was going to cost $200,000. We're going to pay that up front. We've got to pay for getting the water line out to the new site, let's say. Now, the way that this model is set up so that we can calculate the return on investment on this incentive. So this $200,000 incentive is viewed as an investment. And the return on that investment is kind of what we graph out here in this orange line, which are the net benefits to the city. So the net benefits to the city are a little over $400,000. If we remember, we can jump back to our report here and we see that these net benefits, after accounting for the tax abatement, are $424,000. We go back to our graph here, and so roughly that's what that's showing, is $424,000 by year 10. That's our net benefit. Now we're comparing our $200,000 incentive to that, and we can see that our payback period is the intersection of these two lines, the net benefits and the reference line here for total incentive. The intersection of those two is right between years 3 and 4. We calculated it, it was 3.4 years. If we want to look at the average annual rate of return for this investment, it's 21% over the 10-year period. Now, you can look at incentives kind of from any one of these directions. So, for example, some of our clients might say, well, we'll consider an incentive, but 3 years is just too long. We'll look at an incentive that would be paid back in 3 years. I don't know what that incentive amount is, but the model can calculate it. So in this case, a 3-year payback period would be a 23% average annual rate of return, and we can see that that's a little bit under $200,000. It's about $182,000 in the incentive. Now, if we wanted to think about this in the case where we're really kind of pulling on all levers, let's say that we do a situation where we don't want to do that abatement anymore. So if we don't want this abatement to be on, this $144,000, what that means, it's going to mean that this orange line stretches up. It actually is going to go a little bit higher. It's going to go $144,000 higher over the 10-year period. So let me do that. If I uncheck this, we'll see that our line now stretches up beyond $500,000. And our $820,000 incentive now gets paid back in 2.4 years instead of 3 years. So if we wanted to do a 3-year payback period still, we could re-enter our 3, and now our incentive is the total incentive amount is $223,000. You can kind of slice this any way you'd like. So for example, if you wanted to get a 50% average annual rate of return, you can enter that in, and we can see that's around $113,000. Gets us paid back in 1.3 years. If you wanted to do an incentive per job, for example, you might even do, let's say, $5,000 per job. And we had jobs being added over the first 3 years, if you remember. So here's our $50,000 paid out over 3 years. And we can see the payback period in that case is 1.9 years. The incentives aren't being finished until paid out until year 3, but we get paid back at year 1.9. So what that means is by just under 2 years, the city will have collected enough in these new benefits to pay for that full $150,000 incentive. So if we go back to the report now, we can see our $568,000 in net benefits. We can even see analysis of those incentives that we just modeled here. Now, on this one-page report, we've been looking at this from the city's perspective, but we can flip it and say, well, actually show me what's happening for the county. And so if that's the case, we can see now for the county what those net benefits are. And if we're doing any incentives for them, we'll see those here as well. If we go back to our public support, if we click on county, this is where we'd be able to put in a schedule for a tax abatement and indicate what we wanted to do there. We could also look at another incentive from the county's perspective measured against the county's net benefits. We haven't done that in this case. I'm not going to mess with it. So now we have this summary report, which we've looked at in detail. We're able to kind of swap out whichever tax entity we'd like there. But now, if we look at the detailed report, this gives us kind of the comprehensive view. If you print this out, it's maybe 10 to 15 pages, and it has a little bit of a narrative and explains in a little bit more detail what's going on with the project than we're able to do in that one page that gets summarized there. So here we're showing a little bit more detail on the tables with these tables that show extra detail on the impact. We can also see a summary of the taxable property. As I mentioned, there's a number of assumptions that drive these calculations, and you can see those coming together, like in this column of FF&E. We can see the depreciation schedule being applied there. Now, the detailed report that we're looking at gives an overview of the fiscal impact for each entity. And we can see kind of across the board what the net benefits would be for each one of these. And then as you scroll down, or as you would continue on in the report, you can see the detailed tables here for each one of those tax entities, the city, the county, and the school district, and so on. This detailed report also will include information about that public support, so the different tax abatements that are being proposed and the non-tax incentives that we discussed. So that is kind of showing you what this looks like from a Texas client. What I can do is show you also what this looks like from a different client's standpoint. So let me log out of this and just show maybe another state to show some of the differences that we can see across some of these instances. So now I'm looking at a client that is based in Indiana. And if I look at that same exact project, we can see that the inputs are actually a little bit different. So just by kind of looking at these boxes here, we can see that we're not asking about inventories anymore, and we're not asking about taxable sales or taxable purchases. And if we look at the report, what we can see is we've got a line item for income taxes, we've got real property taxes and FF&E and so forth. But we're just estimating the impacts and the taxes that are relevant to, in this case, Boone County, Indiana. And it's going to be a little bit different look depending on the state for which we're preparing this. So I just want to kind of show some of the flexibility of the model here in this case. But the inputs are very, very similar. In this case, actually, for selecting the tax district, it's we can just specify the county where the project is located and then the specific district within that county. And so it kind of populates these other entities. There's only ever 6 entities in the case of Indiana. So it's a little bit of a quicker step than for the flexibility that's there in Texas. I'm going to jump back out and go back into my Texas-based model and show, again, with this idea of flexibility, looking at not a manufacturer as we have with Project Hello, but a more of a retail project. Let's see if I can get this right. All right. So password checking works. We can see that that's a good thing. But we looked at a manufacturer. So let me look at a Chick-fil-A. So we're, as I mentioned, kind of sales taxes are probably more significant in something like this. So for a Chick-fil-A, I've got kind of a similar setup, but now we're selecting the industry for restaurants. There's a little bit lower multiplier. We're putting in the employment. Chick-fil-A hires a lot of people, but they're kind of getting paid a little bit lower wages than what we saw in the other manufacturer example. So now about half of what the other workers were making. The capital investment obviously is a little bit lower. Before it was about $8 million. Here it's just under $1.5 million. And then the big difference is going to be on the taxable sales. So as we get down here to the taxable sales, this example, we've got a Chick-fil-A making about $3 million in taxable sales. And we can see in our results or our summary here, our net benefits over the 10 years for the city are about $620,000. If we go to the report, we can see kind of what's happening with this project. We've got sales taxes of about $525,000. We're getting a small amount of property taxes, then a couple other sources of revenues and costs. But ultimately, the biggest driver of this whole analysis is really just this sales tax piece. So you can see as you work through projects, you're going to see differences in them like this, and you're going to be able to isolate kind of the set of assumptions that are driving the greatest impact. In this case, again, the sales taxes, and specifically the sales taxes from the entity, from the restaurant itself, are the main driver here. And so if there was any sort of concern about whether or not they would hit that particular number, maybe maybe you want to do a scenario where they only hit $2 million sales and taxable sales. How does that affect the overall numbers? And we can see in that case, I mean, it's pretty significant. We can see it drops by approximately just under $200,000. So the model with the ability to kind of run these different scenarios, it's really nice to be able to kind of have control over this and be able to look at these different options yourself. Now, in our example today that we looked at with Project Hello and even Chick-fil-A, we had already entered the information in. So I had already entered this information into the model. But if you were going to do a brand new project, or if you just wanted to do a new scenario, if you click New Scenario here, what that's going to do, it's going to open up a brand new scenario for you, and nothing is selected yet. And so you would have to go in here and identify all the information that we want about the project. So you might have had a conversation with the prospect, and you know what they're going to be doing, and you can put in a little bit of that information and start getting some results, as we can see what's going on here already. If I put in our industry, let's do that, warehousing. We can get some multipliers, and so we're already getting some results here just with entering a few small pieces of information. Now, the other way to get information into the model, I'm going to delete that one because that was just for fun. The other way to get information into the model is to request data from the prospect. So if you need to send a data sheet to collect information about how many people are you going to employ and what's your capital investment. If you need to do that, you can use our app to send a data request, and you can put in whatever the email address is. So if your contact's name is jim@xyz.com, and we can change this up and say, "Hi Jim, please provide information on your project using the data form below. Contact me if you have any questions." And then this one has my contact information, but when we set this up for a client, this is the client's contact information. And when they hit send, or when you hit send as a client, this will send an email to Jim, and you'll get copied on it with a link that sends them out to an input field, or to a data form where they can have these inputs. And this is all grayed out right now just because we're previewing it. But you can see these are the same inputs that we're asking for essentially on the model itself, but they just get to give you the details, and they don't get to see the results. And so we have a couple extra fields that they can, this background input, where they can provide some additional background on the project. They can also, as I say, provide the contact information or some information on the company in the background there. But they have the ability to kind of save and come back if they don't have all the information at once. But once they hit send, so let's say that they send that data back to you, you'll see that now you have received some data. So for example, in my project Haze, I've received data from a project, and I can view that data, or I can create a scenario with it. So really helps kind of facilitate getting the data into the model if that is what you're needing to do. But again, you don't need to use the data request process. If you have the information from some other method, whether you got an email from someone or had a phone conversation, you can just type it in and get started running your analysis without necessarily messing with that data request. Let me think, what else am I missing about the model here? I think the last few things that we talk about is just kind of the organization on this page that we touched on earlier about being able to send data requests. And ultimately, this is kind of how we see an economic development impact analysis really benefiting a community. So for whether it's the city or the county, or whether there's a local or regional economic development organization, we really think that the types of impacts that you see, or the types of results that you're seeing from these reports, really pull everything together for economic developers and city officials, county officials, to make good decisions on economic development projects, whether they're thinking about incentives or other things. These reports really kind of pull everything together, going beyond just the economic impact of spin-off jobs, but tying in also this idea of additional tax revenue, and then how that all feeds back into the incentive analysis. And so the online model that we've been looking at today, called Impact Dashboard, is available on an annual subscription basis. Our typical client right now is like just a single EDC or something. So in Texas, maybe it's a city EDC, or maybe it's a county-wide organization in some states. And the pricing there, it generally starts around $6,000 for the annual license. There's no upfront fee or anything like that. And with that, we set up the model. We build in all of the tax rates and assumptions and other things. We didn't really go through this, but this is the information that we put together to really kind of make this specific to your community or to your region. And we're modeling your tax structure. And so with the annual license fee, like I say, in a typical case of say a county or say one city, it's around $6,000. That annual license fee includes us keeping all that information up to date, building it the first time. There's no upfront fee, and then throughout the year, if you're running reports and you have questions and you want to give us a call and say, hey, I'm looking at a report, but I can't explain why something's happening, we'll look at it with you and either help explain what's going on in that case, or in some cases it may just be an issue that maybe a prospect filled out the data form incorrectly and we just need to kind of clarify some of the inputs. For example, if you're looking at this one and you're wondering why are the net benefits decreasing over time, what is responsible for that? I don't understand why the net benefit is so high in year 1, but it's about half that in year 10. We can walk through that with you. In this case, the answer is really a function of that depreciation schedule and the fact that the capital investment is so heavily on the side of the FF&E, which is subject to that depreciation schedule. So there's just kind of some of the types of things that we might talk about as we license the model throughout the year. Now, we do have relationships with in the case of Indiana, that what we were looking at there was essentially a statewide model that we put together for a utility organization. And so in that case, it was a little bit different than the instance of a single city in a county. But just to kind of tie in that, generally speaking, we can work with whatever the organization is and whatever the region that we're covering. But we do, as you can tell, get into those details about local tax structure and really trying to put in specific tax rates and understand the specific community budgets. So if there are any questions, I guess we'll open up the questions now. There's an ability to kind of ask questions through the text feature there in the app or in the GoToWebinar there. If you have any questions, feel free to type those in at this time. But that is really everything I wanted to cover today. I'm trying to think if there are any other features here. We have this particular webinar is being recorded, so we're going to send out an email with the link to the video tomorrow if you want to have another copy of that, if you want to share that, or for anyone that missed. We can also, if you're interested in kind of follow-up questions specific about your community or about your organization, feel free to reach out to me directly. My name's Paul Shurin with Impact Data Source. My phone number's on the website, pretty easy to find. Just go to the bottom, or feel free to reach out to me directly by email. It's just paul@impactdatasource.com. But I'm not seeing any questions come in, so I'm going to cut things off here. And I really appreciate everyone joining us today, and have a great rest of the week. Thanks.